Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is the 20th of November, and we've got Brent crude oil trading a little change today, but nonetheless, it's at 73.27, so it's above 73, and it obviously threatened earlier in the week to continue a downward trend, heading towards that 70 handle. We saw on November 15th that the recent low where we saw $71 close on Brent, but it has recovered a bit, and we will see as it moves closer to 75 than 70. Let's kick off this morning with Clyde Russell, Asia commodities and energy columnist at Thomson Reuters. I wanted, Clyde, to get your thoughts a little bit on your column this week earlier that you had reported China's crude oil surplus nearly halved in October. That I wanted just to kind of get my head around the halving and the numbers. If you could give us why you saw this as bearish, as weakness from a point of view of China's sort of demand outlook.
Well, if you look at it this way, this year we haven't actually seen very strong Chinese imports, but even with the sort of weakness in the imports, the surplus crude that they have available, which I basically calculate by putting their imports together with their domestic output and then subtracting off their refinery throughput. I know it's not ideal. I know that there's some gaps in the official data, but it gives you a trend. It gives you an idea of what's actually happening. And up until September, that surplus on a monthly basis was around 1 million barrels a day. In October, that halved to just over 500,000 barrels a day, about 560,000. So what you're basically, that sometimes you would sort of say, oh, well, they're not storing as much. That's a bullish signal because they're obviously using, more of their imports and their domestic output when they're refining it. But the simple truth was, their imports fell at a faster rate than their refining did in October. So you had two bearish numbers, weak imports, weak refining, and it just so happened that the imports were even weaker than the refining. So, if you're looking at a year-on-year basis, refining's down for 5 or 6 months in a row, imports are down for 7 months in a row. So that's kind of, giving you that sort of bearish signals. That said, I'll give you a nice big caveat. We're going to see probably quite strong Chinese imports in November, and you're probably going to get a whole bunch of commentary of people saying, oh, this is bullish, it shows China's demand is recovering. That, I think, is actually a little premature, a little bit optimistic. Why are we seeing stronger imports in November, on track for maybe 11.3, 11.4 million barrels a day? We're simply seeing it because at the time cargoes were bought for November, the price had dropped. In early September, it had been a downtrend since August, and it dipped on the 10th of September down just below $70. When the price goes down, the Chinese buy. So it's not necessarily a bullish signal that you're going to get these stronger imports in November. But I will say, be wary of people who tell you that this is bullish.
It's also, Clyde, going into the Chinese New Year in January, and it's winter, and it's typically a time when you would expect demand to sort of pop up in China.
Yes, I think you do get a certain seasonal flow. There is definitely, the history suggests that they do buy a bit more. You also have, we're starting to see with the return of Donald Trump to the White House, there might be a little bit of nervousness and uncertainty of the Chinese buyers about whether Iranian supplies will be available to them once Trump is back in power. So you might find that they're taking advantage of the relatively steady prices that currently are prevailing, and they're topping up as much as they can. Again, I mean, in some ways this is bullish because physical oil will be moving into China, but it doesn't necessarily. It's a sort of temporary factor rather than a fundamental structural change. And if their economy doesn't accelerate next year, all that means is that they'll have an even bigger surplus to draw upon.
Let's leapfrog for the whole other side of the world from Australia to London with Livia Gallerati, Senior Oil Markets Analyst at Energy Aspects. Livia, what seems to be moving the market today is somewhat the return of maybe some geopolitical risk premium threats to oil and energy infrastructure, given the war in Europe that the US has permitted Ukraine to use its long-range missiles to go deeper into Russia. Your thoughts on that being a game changer? Could we see the geopolitical risk premium grow further? Your outlook for the intersection of those two things.
Of course. And thank you for having me back. Before I jump into Russia, if I just may say something on China, because we have a slightly different perspective on particularly on the last point with regards to Iranian buying of from China. What we have seen in the market
China
recently,
buying from Iran, you mean?
Yes. Thank you. What we've seen in the market recently is that some of particularly the bigger independents that had been buying Iranian barrels recently are already stepping away from these purchases. They're dipping into more Middle Eastern grades. They're buying WAF. That to us signals that they are already quite concerned about the stricter enforcement of sanctions from a new US presidency. So what Clyde was saying was like, the sentiment is right, and it's already happening actually. So it should be supportive of your benchmark grades, because a lot of these, obviously Iranian barrels were sold on the gray black market. If you start seeing Chinese refineries buying benchmark grades, that will be quite supportive for Dubai particularly. But that's more of a story for 2025 for sure. Moving on to Russia, I would say that the announcement from the US government to allow Ukraine to use longer range missiles into Russia definitely opens up the opportunity for a return to some of the strikes that we have seen on Russian energy infrastructure, particularly this spring. It's not a silver bullet. For now, the US administration has restricted quite significantly the potential use of these missiles to a very specific region where there is no Russian refineries. But it does suggest that there is potential risk for things to escalate further. So it's definitely something that needs to be watched very closely. For now, we're seeing Russian refineries, which had been struggling a lot because of all of these attacks in the spring. They've been struggling to restart, and there have been multiple issues on several of these refineries. They are ramping up runs now. So I think arguably peak tightness in terms of Atlantic Basin products from the Russia side anyway, it's probably behind us. We're also seeing exports, crude exports coming off. That's a sign that Russian refineries are recovering. But I think it's a very big wild card for 2025, how Russian refinery runs perform if there is a further escalation of attacks, because that has been one of the things that I would say the market has missed, particularly in the latter half of this year, and it's contributed to a lot of tightness in the product market in particular. And it could be supportive of refinery margins next year.
Let's go to Pakistan with Osama Rizvi, energy and economic analyst, Primary Vision. Osama, we've been utilizing obviously our global network of analysts, of which you are one and a very significant one, to get views from the ground around the world in reaction to Trump's election success and also the announced policies. Your thoughts? We've seen reports out of India, which is obviously next door to Pakistan, where it's seen as Trump's return positively is the general sort of headline sentiment. Your thoughts? How is Pakistan reacting? What does it mean for South Asia?
Well, Sean, interestingly, there has been a lot of positivity, I would say misplaced positivity around Trump presidency and the future of Pakistan. The political structure here, or the analysts, they believe that because of Trump's connection with Imran Khan, that might bring him out of the jail, and the thing would take a turn for the good. But I mean, I stay away from politics, but as far as I understand, that is not going to happen. That is certainly not on the priority list for Trump. Secondly, from a purely economic point of view, if you look at Trump's policies, they can usher in an inflationary shock to the world, and Pakistan being an import-based economy with 85% of our oil needs being imported, such an inflationary shock would always mean further trouble for Pakistan, which is already going sort of a worst cost of living crisis. So the reaction has been positive. It stays positive, but unfortunately, bad news. I believe it is going to get tough for the country as Trump is going to ramp up in tariffs against China. That is certainly going to bring in or trigger another set of inflationary shock and interest rate movements, and that Pakistan or countries like Pakistan essentially cannot deal with at the moment.
Clyde, I wanted to get your thoughts on the outlook for OPEC, right? Just digesting your report alone and commentary this morning as they look to China. They kind of had, like all of us, bedded into the China weakness narrative. They're meeting OPEC Plus in 2 weeks' time to make decisions on the new year. What do you think is the sort of guiding light for them? Should they be looking at as you said earlier, warning against sort of buying into the China recovery narrative that some might sell on the back of the November numbers? How do you think OPEC Plus should read all of this?
Well, I think it's quite clear that they're actually going sort of month by month at the moment, and I think that's probably the sensible thing for them to do. They have to really wait till they actually see concrete signs of a sustained recovery in demand rather than just a little boost here and there. That is possible, but let's be honest, there's now a lot of caution. People are waiting to see if Trump actually does what he says he's going to do, or if it's all bluster, or if there's going to be lots of exemptions carved out, or it's, with Donald Trump, it's a movable feast. You just don't really know what you're getting until it's actually announced. And, if you sort of think, what is the best way to respond to that? Well, you actually have to try and just cut out all the noise and look at the actions. What actually is going to happen? What is he going to do, and when is it going to happen? And if you
he's certainly appointed. He's certainly
wait and see. I don't see them putting extra barrels back in the market until there's real evidence that those barrels are actually needed. But I think we're still a little bit short of that. I am seeing some sort of signs of recovery in Asia outside of China. There's certainly been a little tick up in India's demand in recent weeks. There's been a little bit of buying, but it could be more seasonal for South Korea and Japan. So they do tend to buy a bit more going into the northern winter. So I think we're starting to see a little bit of that, but whether it's sustained into the new year remains to be seen. And now we've got an enormous sort of we just don't know what's going to happen with Trump, and people are going to probably be cautious around that.
Livia, just picking up on that, I mean, what does seem pretty consistent, and it was very much a feature of Trump's first administration. It carried through Biden, maybe with less hostility, but now clearly with all those he's appointing thus far are pretty much China hawks, and he's announced tariffs of significant level against China and against the whole world, but most notably China. How does that all impact China's ability to grow next year, China's ability to continue to be obviously the world's largest importer of oil and of all commodities? But how does all of this tariff threat specifically to China, which of course is already struggling with certain issues?
I would say, I mean, as Clyde has already highlighted, we've already seen a pretty weak China in terms of demand this year. So of course, potentially higher tariffs next year are a worry, and I mean, everybody in the market is focusing on that. The general consensus, I would say, at the moment is that the Chinese government stimulus that has been laid out so far is not enough to reflate the Chinese economy, and you'll see a China that is maybe going to look a little bit better next year, but it's not going to come back roaring from some of the issues that we've seen this year, particularly when it comes to the property sector. Arguably, the thing that has performed the best in China this year has been on the export side, and with higher tariffs, that's going to be potentially a big problem. Yeah.
On that, do you guys, I mean, what's your thoughts on the China stimulus? We've seen a few sort of steps in that journey. Do you feel they're committed to making it work, whatever it takes, or is this going to be a sort of a tepid, just to make sure you don't get the worst outcome for the economy rather than potentially the best outcome? What's your house view on how committed China is to sort of really making this stimulus impactful?
We think there is more coming in Q1, so that should help. It's hard to get a sense of, I would say, the commitment. I mean, that depends on your perspective. I think what is fair to say on China is that probably structurally, China, in terms of oil demand, it's not going to go back to where it was, say pre-COVID. There have been some structural shifts in the economy that mean that it's just less oil intensive, particularly when it comes to some forms of transportation. We've seen a big switch from diesel generation to LNG generation for your heavy goods vehicles. There's obviously the EV story, which I would say, compared to the LNG story this year, has been a little bit less impactful, but we see Chinese gasoline demand peaking in the next couple of years. So it's a structural shift. So I think we need to get used to a different type of China, and that is not to say that global oil demand doesn't keep growing, at least in the near to medium term, because there is other economies, and India was mentioned before, but other Asian developing economies that will support growth. But yeah, China may not go back to where it was before pre-COVID.
Osama, looking at the sort of engine of India picking up some of the slack going into the new year, oil demand, where is your sense of that? It looks like since Narendra Modi's election earlier this year, without a majority, has to go into coalition, he's lost a little bit of his mojo, and India seems to have, as a result, also lost a bit. We've seen the stock market sort of plateau and so forth. Your thoughts of where India is going in this big sort of juggernaut of its own reform and revolution of economic growth?
Well, I'd like to add two more things and connect it with the question. First
Please.
of all, I absolutely agree with Livia. I mean, there have been some calculations, and they say that China will need further $800 billion of fiscal stimulus to offset the impact of the rise of 60% tariffs. So, I mean, certainly another set of fiscal stimulus is bound to come next year. Secondly, if we look at the global commodity reports by the World Bank recently released, they expect oil prices to fall around 6 to 10% in the next year, leading all the way to 2026. And they also expect the oil supply to exceed the oil demand by 1.2 million barrels per day, which has happened only twice before, once in 1998, and the other one during pandemic, which ties to your question, Sean. I mean, if this is true, like if this will happen, and the demand outlook does seem gloomy at the moment. So in terms of India, in terms of China, in terms of other Southeast Asian countries or east of Suez demand, it looks a little bit tricky. And the reasons are, of course, first of all, a stronger dollar. If the stronger dollar tends to have an inverse impact on the oil demand for countries like Pakistan and India, of course. And then there is a lot going on in terms of debt. If we look at the rise in global debt, public debt, you will see that about 50 or 60% of it comes from the non-OECD countries or this part of the world. That is also something that we need to look at. Interest rates are down, but still not as much as to spur further investment. So I mean, even in Pakistan, interest rate hit at 22%, highest ever. And even after reducing them for like 3 consecutive meetings, it still stands somewhere at 15-16%, which compared to where it was before COVID, 8 or 9%, is almost a 100% increase. So I believe I will loop all of the region and India's demand and China's demand with a big question mark leading into 2025, with the majority of the direction or the trigger coming from the West, specifically the US and Trump's policies.
Let's go to the survey question, which is looking at the sort of immediate direction of travel for oil prices. Can the geopolitical risk to oil supply infrastructure in Europe and Mideast keep Brent oil prices averaging closer to $75 a barrel than $70 through the end of the year? We've seen this market, its natural sort of resting place seems to be towards 70, and anytime it gets there, there's we're reminded of geopolitical risk, as we were most profoundly in October with the Iran-Israel face-off. Prices went up above 80, but here we have the European version. I mean, this missile issue that's emerged over the last few days. Potentially, we've been warned for many months that it was a game changer in this war. Will it indeed turn out to be? So question ultimately, as we go through the end of the year, a year in which we've seen Brent average closer to 80 for the 12 months or for the year to date, but over the coming rest of the year, Brent oil prices averaging closer to 75 and 70, and the geopolitical risk will be the sort of elevating balloon, despite everything that we're talking about, OPEC, etc. Clyde, I was thinking that the big question for OPEC Plus, as we mentioned and talked a little earlier, is how they read China and where China is going. And I would recommend to them that they read Kevin Rudd's new book, which I've just done, which is on Xi Jinping, how Xi's Marxist nationalism is shaping China and the world. I find that quite often we review China, as you do, obviously, on the granular level with the import numbers, export numbers, and so forth. And we have that sort of Western market analyst view that, of course, they're going to stimulate, they want this economy to grow and so forth. But really, what Kevin Rudd tells us is that China has structurally changed significantly under Xi Jinping's leadership, and where the Leninist Marxist sort of government policy is really the driving North Star, not growth at an economic next quarter perspective. I just wanted to get your thoughts. I don't know if you've read the book, but thought about that the structural change to China is really what's put it on this path to a slower growth number. I just wanted to get your thoughts on some of that, as I also...
Well, I think it's, if you look at the big picture, I mean, China was never going to grow at 10% a year indefinitely. At some point, it was always going to decelerate. And if you look at what Xi Jinping is actually trying to do, he's trying to do it in an ordered and structured way, which is, in some ways, it fits very much with their sort of philosophy of, a command and control economy. Their social compact is, we will deliver you safety, security, and a rising standard of living. And in return, you, the people, don't. I think what we're seeing is that sort of thing in action. So they are trying to restructure their economy a bit. They know that they're not going to be the world's factory forever. They know that they have to swing it around to a little bit more consumer-led. So I look at all the stimulus measures that they've done. It's not really stimulus. It's just like cleaning the cupboard out. It's making things, getting rid of a lot of the problems that have built up and have been swept away. So they're now sort of cleaning up the local government's financing and things like that. So what they've done this year is set themselves up for a better year next year. And then they're going to look and see what the actual impact of Trump's return is. I've been thinking about this. Everybody sort of thinks it's absolutely awful that there's going to be all these tariffs. It's inflationary. It's going to do this kind of thing. It all depends really on how the rest of the world responds. But if you actually think about it, the Chinese are really going to want to export. If they're losing markets, part of their markets in America, they're going to want to export to the rest of the world. That can actually be deflationary for the rest of the world, because they'll be keen to make deals. They'll be keen to sell things at a cheaper price. They'll be looking to move all that capacity they have in solar panels and battery electric vehicles. They'll be looking to go into the global south and really push those kind of products, and they can make it happen. So it could actually be in some ways deflationary for the rest of the world, inflationary for America. And that sets a very, very interesting dynamic. If the American consumers are facing higher prices and a stronger dollar, and the rest of the world is actually getting a deflationary impact from China and is able to sort of maybe not make up the whole trade slack, but some of it, you set up an almost a decoupling situation. I don't think people thought too much about that. And this is why I say, the hallmark of the first Trump administration, if I could pick one word, was incompetence. They weren't really good at anything. The hallmark of what the risk is for the second one is that they actually are getting better at doing things. They're just doing the wrong things. So it could be quite an interesting dynamic. And I think everybody's just they're going to have to wait and see what actually comes out. And you just don't know that until you start getting into February, March next year.
Well, you start to see it, I suppose, when you start to see the people that are being appointed into the principal positions, the thing starts to shape up. But Livia, I wanted to get your thoughts. Obviously, Energy Aspects does track OPEC issues very closely, and Saudi Arabia's leadership of OPEC and OPEC Plus. And I'm wondering what your thoughts on how they're approaching this next big meeting, in which they've postponed their plans to increase output to January 1st. And as things stand currently, OPEC Plus, the 8 countries within it that have announced the plans to raise supply from January 1st. What do you think their thinking is? They've made some big issues about the countries that have been violating their quotas, i.e. producing more than they should be. Have those countries got into line now? How do you think they go into this meeting as a cohesive group and planning for the new year, led by Saudi Arabia?
On compliance, Russia has been complying for several months now. Kazakhstan, they have been doing maintenance, which has helped them improve compliance. They're not complying fully, but it's better than it was before. Iraq, I have still some significant issues there, I would say. When it comes to what their next decision will be, as always, OPEC will be looking at inventories. Ultimately, that's what they care about. Are global stock builds drawing, or are they building? And are inventories below or above the 5-year average? That's kind of the key metric for them. I think there is a real sense from the group that adding back supply in Q1 is generally not a good time to do it. It's seasonally the weakest time for the oil market. So they understand that, which is why, look, I think all options are still on the table. If we maybe had to put a percentage likelihood on what the most possible outcome from the meeting might be, is that is probably that they will further delay the increases to production. It may be not just by 1 month, it could be even by a few months, potentially until Q2. But delaying by several months will depend on general agreement within the group. So I think that might be harder to pass.
Osama, you get the last word today, and I wanted just to close out on Pakistan specifically and its $7 billion loan package with the IMF. You had a review recently, 5 days of meetings in Pakistan, where the IMF identified some worries about the ability of Pakistan to implement what it needs to, agricultural income tax legislation, different challenges that remain. But one of the things the IMF recommended Pakistan was to approach Saudi Arabia for deferred oil payments and China for debt rescheduling. Your thoughts on those two issues? Pakistan's ability to get Saudi to defer oil payments and China for debt rescheduling?
Well, we have been doing that quite a lot. And in the previous few months, there were actually some sort of resistance especially and interestingly from China in the debt rollover. So moving forward, I would believe that both Saudi Arab and China would be more cognizant of the actual improvements or the any indicators that the Pakistan's economy is actually going somewhere, and they will base their decision on that. On the ground, I believe the government face a really tough choice because IMF's program, what it wants us to do is exactly the opposite what the people want at the moment, right? People do not want austerity. They do not want higher medicine prices and higher food prices. So it's bit of a pickle for the government. It is going to be a difficult 2025 for Pakistan, only because they have so many factors that are out of their control that we have just spoken about. So for the debt rollover and deferred oil payments, I think it is not going to be as easy as it was before.
Okay, well, we'll have to wrap it up there. The vote survey results sort of indicating that no, that the against the thesis, if you like, that Brent would average closer to 75 than 70. So we'll post that on social and see if the wider views. We had a great interview with Dr. Sarah Vakshuri all about Trump's return, based in Washington, as a great insight to the geopolitical and macro view from there. And so that interview will be posted in an hour's time. So thank you all. Thank you, Livia. Thank you, Clyde. Thank you, Osama. As always, great to have your insights from all over the world, Australia, Pakistan, and London. And we wish you all a great day. Thank you. Bye-bye.
You.
Bye. Thank you.